Greetings, class, and welcome to Wednesday, April the 22nd. In this video, I'm going to talk about some announcements that are important to remember for the class, as well as our final chapter of material that we're going to cover, and then finally do a demonstration problem that will help you become acquainted with some of the terminology that you need to be aware of for the exam. Now, this problem I'm going to present is not really a problem the way we would compute it typically, but it is a problem that will help you become familiar with the concepts in Chapter 14, the Statement of Cash Flows. So for announcements, Chapter 13 homework assignment is available here. It's due next Wednesday, the 29th. Again, this is a brief assignment. It's shorter than the one from Chapter 12. And by the way, in case you missed it, I put a video up last night related to Chapter 12 homework. And so, because there was a problem in Chapter 12 in the homework that I didn't realize was there and may have caused some confusion. So, I felt like I needed to give you a video in order to help ease some of that confusion. So if you are working on Chapter 12 homework and you didn't get it submitted by last night, make sure that you do that and make sure that you look at that video as you do that. For today, I'm going to highlight, I've already mentioned the Chapter 13 homework, but also there is a new discussion this week. And I want you guys to go in and respond to these three questions that I've placed into this discussion for this week. Make sure that you get in and respond to those. Um, and again, that discussion is basically going to be for attendance type points, and it is worth 2 points. So it's worth some points to do this. It also will help me out a little bit as we prepare for the final exam, and I would appreciate you going in and responding to the questions that I've asked. Anyway, that's really it for the announcements today. So, to go on to our next topic, we're just really going to look at Chapter 14 briefly, the Statement of Cash Flows. So, let's take a look at that PowerPoint. The Statement of Cash Flows is one of three reports that we're going to issue to outsiders in a business. We have the income statement, the balance sheet, and we've talked about that in Accounting 201. And we've talked about some of the components of it here in Accounting 202. But those two statements prepared on an accrual basis don't really tell us about the cash in the business. They tell us about the income on an accrual basis. They tell us about the assets and liabilities, but they don't tell us about how cash flow is in the business. Because of that, the AICPA developed the statement of cash flows. Now, initially, they developed a statement of changes in financial position that was a little more complex and a little more complicated, but they've since moved away from that and moved to this statement of cash flows, which I think you'll find much better to work with. And I certainly think it is an improvement over what we had before. So the statement of the cash flows is really to answer a few questions. Number one, how much cash are we generating in the business? Can we pay our debts? Can we pay the dividends? And why do net income and net cash flow differ? It'll show the components that make up that difference. And, um, and to what extent will we need to borrow money to make any needed investments in the business? So basically, the big principle behind this statement is this: a change. And by the way, this delta means a change. A change in cash balance is equal to a change in non-cash balance sheet accounts. So really what that means is we're going to look at the balance sheet account changes in order to figure out what the change in the cash balance is in this statement. So a few basic equations we're going to look at here. For asset accounts, we're going to take the beginning balance plus any debits minus any credits, and we're going to get an ending balance. For any contra asset, liability, or stockholders' equity accounts, we're going to look at it like this. Beginning balance minus debits plus credits is going to be the ending balance. So we're going to start out in the statement with a category called cash and cash equivalents. Um, and basically what that means is this: we have a certain amount of currency in our bank accounts. Uh, that's very clearly cash. Any kind of money you have in your bank account that you can get quickly, that's cash. So that currency is available as cash. But we have cash equivalents that are things like money market funds, commercial paper, treasury bills. And what we do, the reason we have these is we may have some extra cash. We want to put that to work. We don't want it just to sit around and not earn interest. So we basically decide, okay, we'll purchase some short-term treasury bills, some short-term commercial paper, or money market funds in order to earn a little extra interest income on that extra cash that we have. So the first thing we want to do here in chapter 14 is classify all cash inflows and outflows related to one of three major categories. The first one is operating, the second one is investing, and the third one is financing. Now, these categories don't break down in ways that you might expect them to, and we'll explain that as we go. So, first of all, we're going to have three segments in the statement of cash flow. We're going to have operating activities. These are going to be all revenue and expense transactions that affect net income. We're going to have investing activities, which includes, and this is not necessarily purchasing stock or saving money in the bank, but this is going to include acquiring or disposing of any non current assets. So when we say investing activities on the statement of cash flows, what we mean is we may be purchasing or selling some long term assets. And then financing activity really means we're borrowing from or repaying money to creditors, and we may have some transactions with stockholders where we issue additional stock and they give us money for that. That's considered a financing activity. So that's the big three categories, and I would say you need to know these and how they break down and what they are. So know what goes into operating activities, investing, and financing activities. When we organize a statement of cash flows, it'll look something like this. When we think about this, we're going to, under operating activities, we'll collect cash from customers, we'll pay suppliers, we'll pay bills, we'll pay wages, we'll pay taxes, we'll pay interest, and so on. And basically, that's all going to relate to operations. Investing activity would be where we purchase property, plant, and equipment, or if we buy stocks or bonds, or if we sell stocks or bonds, lending money to another party, and so forth. Financing would be borrowing money from a creditor or even collecting cash from the sale of common stock, which is what I mentioned earlier. There are two ways to prepare the statement, and one is a direct method, and that's going to be a little more complex because you're reconstructing the income statement on a cash basis from top to bottom. What we're going to do here is the indirect method, and it's a very straightforward approach because what we're going to say, we're not going to change the net income, but we're going to start with net income and then adjust it for cash changes in the assets, liabilities, and other accounts that will impact cash balance. So here are the steps. First one is we want to start with net income, and we're going to add depreciation back to net income because it is a non-cash expense. Remember, we were working with that in chapter 13 some, but depreciation is a non-cash expense, And because of that, we're going to add it back to net income because we are going to create this statement on a cash basis. Then we analyze net changes in non-cash balance sheet accounts and adjust for any gains or losses. So when we think about this, for the first step, we're going to add this accumulated depreciation, or we're going to add depreciation back. So let's look at what we do here. This is an example. We have account activity for accumulated depreciation. We have a beginning balance, an ending balance, and accumulated depreciation for an asset that was sold. So we take the beginning balance minus the debits, which is what we sold, plus any credits. We get a balance of $500. We take $500 and subtract out the ending balance of 300 plus the $70. And so we wind up with a credit balance of 270. So we're going to be, that's the change in the depreciation account. So here's how we're going to do the other accounts. This is a very straightforward. When we look at current assets and accounts receivable, if there's an increase in an account balance, we subtract it from the cash flow. If there's a decrease, we add it in the cash flow. The increase means that we're not collecting as much cash. The decrease means we're collecting more cash. Inventory is the same way, and prepaid expenses are the same way. Increases in these accounts mean that we're not selling enough inventory to generate cash, or we're not using up our prepaid expenses as quickly as we anticipated. Current liabilities are the opposite. So you can see the current assets here, if they increase, are a reduction of cash. But if we increase current liabilities, we're actually increasing cash because we're increasing those balances and not using our cash to pay those down. If we have a decrease in those liabilities, it's always a reduction in cash. So if we have a gain or loss, we need to remove those from the net income and the income statement to show them in order to show that in the investing activities section. So what we're going to do is subtract gains and add losses to the net income. Okay. So other accounts, non-current assets, these are long-term assets. If we have an increase in those, we're talking about plant, property, and equipment, long-term investments, or loans. Any increases is going to be a reduction in cash. However, if they decrease, we're going to add that to cash. Likewise, any liabilities and stockholders' equity changes are going to be the opposite of these. So if we increase bonds payable, we're going to add that to cash because we're issuing more bonds. If we reduce those, we're going to reduce cash because we're paying them down. Likewise with common stock. Retained earnings, basically, you would need to analyze that a little further to be able to figure out what cash dividends were actually paid, because those cash dividend payments would impact cash. So here's an example count activity for plant, property, and equipment. You have a beginning balance, an ending balance, the original cost of equipment sold, the accumulated depreciation, and then a gain on the sale of equipment. And then you have some cash as well. So when we look at this and we do the calculation, we're going to show after we go through all of the steps here, we're going to show a $900 cash outflow because this balance has increased. This balance increased. So the net difference is going to be a $900 cash outflow. We have a $40 cash inflow because we had some cash from the proceeds, but we have a $900 cash outflow because this balance increased. Retained earnings, like we said, if you're looking at those, you need to figure out, okay, what actually in those is related to issuing stock dividends. So again, we're going to look at that and figure out what belongs where. So in this, they do this calculation in order to account for the net income changes. And so what we have, when we get done with the calculation, we've added in the net income. What we're saying is we know the beginning balance was 2,000. We don't know what the dividends were, but we know the net income, and the ending balance we know. So we're calculating this debit here is going to be the dividend payment. Okay, so here are how we would divide the statement of cash flows: operating activities, investing activities, and financing activities. So um, basically, at the end of it, we would total up all three and we would say there's a net increase or decrease in cash equivalents, and then compare that to our beginning cash, and then identify what the ending cash is. Or actually remove the beginning cash from that so we could account for that. So really, in terms of what we're doing in this chapter, I'm not going to ask you to prepare a statement, but I want you to be aware of some of those, really these basic things here. Um, this is a good example of how to prepare the statement. I'm not going to ask you to prepare that on the final exam, but this is a good tool to review. You start with net income, and then you start making adjustments to convert it to cash. You add depreciation, and then go through the changes in the accounts, non-cash balance sheet accounts. So, like current assets, current liabilities. You adjust for gains and losses. If there was a gain on the sale of an asset, you add that in. And then you have the net cash provided by operating activities. So, operating activities is always going to be based on current assets and current liabilities. If you're looking at investing activities, and by the way, that will be included in the total when we get to the end. We're going to look at what we've purchased or any sale of equipment. So this is long-term assets, sale of long-term assets, purchase or sale of any long-term investments. And then we have, when we get done with all of that, the net cash provided or used in investing activities. And then for financing activities, we look at, okay, what did we issue? Did we issue bonds? If we did, we raised some money. Did we repay principal? If we did, we're using cash. If we issued stock, we're going to receive cash. If we purchased some of our own shares of common stock, that is treasury stock, to buy it back, then we used cash. If we paid a dividend, we also use cash. So the net cash provided by or used in financing activities is shown here. Then we're going to total all three, and we come up with the net increase or decrease in cash equivalents. Compare that to the beginning cash, and then identify the ending cash. So I think really for the purpose of this class and what we want to do with this, this is where we're going to stop going through the slides, because I'm not going to ask you to actually do the preparation of a statement, and that's what this next example does. It is a good example, but in this example, what they're doing is they're looking at the changes between the current assets from the ending and the beginning balances to come up with what we would actually adjust in the statement of cash flows. And you can actually see that here as they prepare the statement. Now, right now, what I would like to do, instead of going through all of that in detail, is I would like to go back to this demonstration problem that I said I was going to mention, or I mentioned earlier I was going to do. In this problem, we have an example of changes in accounts, and we need to identify where they go or where they should be included in the statement of cash flows. So this is, by the way, this is a good exercise. It's not necessarily a problem, but it does show you how these break down, and it is based on that material I went through in the PowerPoint. So let's take a look at the worksheet here that I've copied all this information into, this Excel worksheet. We have the changes that were mentioned earlier on the document. Now they want us to prepare an answer sheet using the following column headings. And we're going to do, we're going to show the item, the amount, and whether we're adding it or subtracting it. And I need to make this column bigger because we're not going to have enough room. But we're going to include these items that they have up here. So in these items, we're going to put those and identify where they go in the statement of cash flows. So to start with, we have an increase in accounts receivable. So we have accounts receivable. And we had an increase of $40,000. And that's right here. So we're going to, since we had an increase, this will be a subtraction from the operating expense section. So we're going to basically reduce the cash from operations for that increase in accounts receivable. We have the next item is we have inventory. And when we look at that change, we see a $150,000 decrease. Now remember, we have we have $150,000 decrease. Let me just do it this way. But since we had a decrease, I'm showing it as a negative number here. Positive number for increase. So because it decreased, it's going to be in addition to the operating section of the statement of cash flows. We had next prepaid expenses. And the amount for these were $4,000. And we had a decrease there. So I'm going to do that just like I did the 150,000. I'll do 4,000. So we have a $4,000 decrease in prepaid expenses. Because we're going to add that to the operating section in the statement of cash flows. Okay. All right. The next item that we have up is our accounts payable. And our accounts payable is also a decrease of 57,000. Now, because accounts payable are liabilities and they decrease, that means we had to pay some of our accounts down. Therefore, this is going to be a subtraction in our statement of cash flows. So instead of an addition like we had here, we're going to have a subtraction. For the item that says we have, where is it, accrued liabilities, we have a $6,000 decrease. And so accrued liabilities are things like accrued interest, things like that, or accrued taxes. So we have accrued liabilities that decrease by $6,000. And we're going to identify that as a subtraction as well, because what this means is If the liabilities are dropping, it means we're using cash to pay for those. Okay, then we have income taxes payable. And this item, when we go back up here and look, is a $13,500 increase. So what we're going to do is we're going to say 13.5 as an increase. This is going to be in addition to our statement of cash flows. In other words, we're going to add that in because it increased. All right. And these, by the way, are going to all deal with operations, these first few items. Now we get to the next item and we have a sale of equipment, which is a loss. And so in this case, we're dealing with an investing activity. So we have a sale of equipment and we have a loss of $4,000 on that sale. So the loss, if you remember, the loss is added back, the gain is subtracted. So we're going to add back the loss here. And then the last item is the sale of a long-term investment at a gain of 16,000. So when we do that, we have a gain of 16,000. And because we add a loss, we're going to subtract the gain. So that's really it for this problem. And it really is a problem just to illustrate how we set up the statement of cash flows. Now, I know that many of you have some awareness of this from Accounting 201, but I wanted to bring this to you today, and I will post this Excel worksheet in Canvas so you're able to look at this at a later time, go over this. By the way, this is a good review. Good review question for looking at what might be on the final. Again, like I said, I'm not going to put problems on the final, but this is not necessarily a problem. This is a concept where you need to be able to say, okay, where do these accounts go? Where do they belong on the statement of cash flows? Sale of equipment is financing or investing, and sale of long-term investments would also be that. So anyway, I hope this video helps. This is the problem I wanted to cover. I will be making a video and posting it on Friday. That video will be related to the final exam and will be a review of the multiple choice type questions that'll be on the exam. So if you have any questions, feel free to let me know. Again, remember for this week, make sure that you complete the discussion and Chapter 13 homework. And again, if you have any questions, be sure to be in touch with me. I'll be glad to help you out. Take care and have a great day.